The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we're going to be talking about money today. We've got a great guest. We've got things to discuss. We've got a lot to cover today, so let me get started right away. First of all, suppose you received an email, and the email recommended this stock that was going to go up, told you it was going to go up. And you looked at the email, you took it, you wait and watched the stock. And sure enough, after a month, the stock had gone up. And now you get a second email from the same person who says, this is a stock that's going to go down. And you watch the stock, and sure enough, it goes down. And at the end of that month, you get another email and says, here's another stock that's going to go up. And you watch and you look, and sure enough, it goes up. And then at the end of that month, you get another email that says, here's another stock that's going to go up. And sure enough, it goes up. And this process repeats itself. This stock is going to go up, this stock is going to go down. And it happens for 10 months in a row. And every single time, the person who sent in the email is correct. And now in the 11th month, you get an email saying, see how good I am. I would like you to make a large investment. Would you do that? Right. 10 times you've gotten an email, and 10 times they've been right. You know, well, the whole point is what you don't see, because that person sent out 10,240 letters or emails to begin with. And in 5,120 predicted the stock would go up, that stock. And in 5,120 said the stock was going to go down, an equal number, up and down. And for those who got the email that said it was going to go up, if it went up, he divided again into two. So he sent out 2,560 letters saying the second stock was going to go up, and 2,560 and said the stock was going to go down. And for those who got the email where he was wrong, they never heard from him again. But for those 2,560 who had gotten the right one, he sent out an email again. This time, 1,280 that were going to go up and 1,280 were going to go down. And when he was right, 640 got a new letter that said it was up, and 640 said the next stock was down. And then 320. And then 160, and then 80, and then 40, and then 20. And at the end of the time, that person had 10 people who had been right. Started with 10,000 and ended up with 10 who he requested a big investment. So that's the classic Baltimore stockbroker. Very classic, that's been around a long time. It's what you don't see that really counts. It's what you don't see. But my industry is full of those things that happen. It's what you don't see that really counts. You know, you hear all the talk about mutual funds and how they do. When I started in the business, I was a young stockbroker. I was primarily a stock jockey. But when people would leave the firm that I was with, or any of the other big brokerage firms, the big firms, the idea was once they left, and people would usually resign on a Friday afternoon and leave, and the firms would take all their accounts and pass them out to the remaining brokers. And you would call those accounts and try to keep those clients from transferring their accounts to the broker that was moving. And usually the broker who was moving would get a big payout, and so he had some incentive to move. And you'd tell him how wonderful you were and how terrible that person was. And I made a couple moves, I can tell you, that happened. But I can remember my first time inheriting accounts. And I inherited an account where a woman had just had $10,000 placed in a mutual fund, and she'd put the money into a mutual fund, $10,000, and she'd invested that like 3 years before. And the mutual fund now, actually it was 5 years before, and the mutual fund now stood at $8,000. It lost almost 20%. It was down not quite. It was down a little less than $2,000 out of $10,000. And so that was a person that chose to stay with me. She had invested with the other guy that moved on and wasn't really happy because she'd lost 20% of her money in 5 years. So she chose to stay with me. Now, in those big firms, you have mutual fund wholesalers that come around. These are people that work for American funds or work for one of the big fund companies, Prudential, whoever it might be, Fidelity, whoever. They come into the brokerage offices and they tell you about how wonderful their funds are. And in this one case, the Focus Fund was this very fund that this client had. And he put up a chart showing that the track record was gaining 20% a year for 5 years. This is a fund that had had a remarkable track record. And when I first looked at it, I thought, maybe the fund that was written down in my book was wrong. The fund that had been recorded in this client's account. So at a break during the presentation, I went and I looked, and sure enough, it was the same fund. That fund they were advertising at up 20% per year, actually, from 5 years before, was down 20%. Total, down 20%, and they were advertising this great track record, and you should invest in it. So I came back and I asked the question, how can this be? And the wholesaler didn't really know how to answer that question, but as I began to dig into it, I found out this is the real story. This is the Baltimore stockbroker part of this story, because what had happened is the fund my client invested in was losing money. So what they did is they merged it into another fund. The one she invested in was a much, much larger fund. And they'd been losing clients out of this fund. People had been withdrawing their money, but it had been a slow process, a bleeding process. But they had a very small fund that was 5 or 6 years old that had a remarkable track record. It was maybe 1/10 the size of the fund that my client was in. But they combined those funds, and they kept my client's fund name as the fund and attributed the track record to this fund. It's the Baltimore stockbroker approach to mutual funds. Of all the mutual funds that are launched, about a third never make it out of the chute. A third of the funds that are launched, they're launched to build a track record of 1 or 2 years, and when they don't have a good track record for 1 or 2 years, they close it down, and that's something you never see. But the rest of the funds get launched. And if you look at the track record, Gary Palmer did a study called Harder I Practice, the Luckier I Get. Not so with mutual funds. They looked at the career paths of mutual fund managers and how much they had done. The article was actually published in conjunction with Gary Porter and Jack Triff's in the Financial Analyst Journal back in 2014. And they looked at 2,846 mutual funds and 1,825 managers. Of the 1,825 managers, only 195 lasted 10 years. Slightly over 10%. 90% were removed as managers. 19% were removed within a year. Another 19% were removed in the second year, so almost 40% of the managers were gone within 2 years. In the third year, another 17%. And over half of those lost their jobs, were not just eliminated or moved out, they were fired. In the fourth year, 12%. So in the first 4 years, 2/3 of mutual fund money managers are moved out of the way. That's why when I talked in the past about a kids market. That's why you see mutual fund managers, the average mutual fund manager is less than 30 years old. That was true 8 years ago. It's true today. Less than 30 years old. That means they never went through the Great Recession. They were in high school or grade school at the time we went through the Great Recession. They have all the head knowledge of it, but they've never lived through that kind of a time. They've never watched their neighbors lose their house. They've never watched people lose their jobs. They've never watched people who are terrified that they're going to lose their jobs. They've never watched people have to go back to work because the retirement funds have been deleted. They've never watched all those emotional things that go on. They get a picture in their head, a non-emotional, very, very straightforward picture, but they never live through the emotional aspect of that. So when they begin to talk about a drop in the market, they don't get what it means emotionally to most people. They don't get why people pull out of their 401ks. They don't get what happens during those times. But it's the Baltimore stockbroker. You don't see everything that's going on inside. You just see what the companies wish to put out. Now we're coming up to commercial break. Don't go away. I got more to say. We've got a great guest coming. And I want to talk about the Great Recession once we're done. Please don't talk again. I'll be right back. Don't go away.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Compensated.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I started the program talking about the Baltimore stockbroker, where you get these emails saying a stock's going to go up, but it goes down. They're right for 10 in a row, and then they ask you for a big investment. What you don't see is, of course, they started with 10,000 clients or potential customers, and they work it down to just 10 at the end, being right 10 times. Every time they're wrong, you never hear from them again. That's the Baltimore stockbroker. That's the historical story of the Baltimore stockbroker. But, when people are talking about mutual funds, very often they're talking about expense ratios and fees because those are very visible things. When they say that lower fees mean better performance, that's something that can be quantified, and you can look at it over term, and it's logical. Of course, if everything is equal and you're paying a lower fee for something, you're going to get a better performance when the fee's lower. But what you're looking at is a large population. If you flip a coin 4 times, what's the probability you're going to come up with 4 heads? If you flip it twice, it's half. If you flip it once, it's half. If you flip it twice, it's a quarter. If you flip it 3 times, it's an eighth. If you flip it 4 times, 1 out of 16 times, you're going to come up with 4 heads in a row. But if you flip a coin 1,000,000 times, you're going to come up very close to 500,000 times heads and 500,000 times tails. So the bigger the sample, the more you're going to go toward the average. And that's when you're dealing with, whether it's a survey or whether it's a number of funds, when you're dealing with a large number, it tends to go toward the median, to the median or the mean, if you're a mathematician, the average. That's where things tend to head. When you look at surveys that are done, presidential surveys or Senate surveys, or surveys about different aspects, when you work the numbers out, if you do a survey and ask 1,000 people, the margin of error is about 3 or 4%. So that's a normal kind of thing when you're asking 1,000 people. If you ask 4,000 people, you're not going to get that much of a change from 3%, maybe down to 2%. So if you look at surveys, it's a law of large numbers. And so that's what's happening when they look at 4,000 mutual funds. You're looking at a population where you look at an average performance. And so there, when you begin to classify by fees, you're going to end up almost invariably showing that lower fees means better performance. It's the averages that count. But when you begin to focus on performance, not on fees, but on real performance, you begin to find a very different picture. Janeta Fundex looked at the particulars. What they did is they did a lot of research into mutual funds that had had the same manager for 25 years. The same manager for 25 years. And they looked at 10,454 mutual funds and ETFs, but only 269 had survived 25 years, the funds themselves. And when they looked at it, they found that of those 269, it was not fees that counted. It was performance that counted. The best performing funds, some had low fees and some had high fees. It wasn't the fees paid. It was the management and the longevity of the management. Selecting just low fees would not lead to a winning strategy. That's what they found. They looked at 10,000 funds and ETFs. R.W. Baird did a study of 370 mutual funds that had outperformed their benchmark over a 10-year time period by an average of at least 1% per year. They looked at over 10,000 funds in that study, and they found that 370 had actually outperformed their benchmark by an average of 1% per year. So if the average fund had gone up 8%, these funds had gone up an average of 9% per year. But when they looked at it in detail, 100% had a long period of underperformance of at least 1 year, most over 3 years. 85% had underperformed their benchmark by at least 3 years. So if you looked at that 10-year time period, they outperformed in total, but for a period of 3 years, they underperformed. 50% had been down at least 10% below their benchmark. 25% down 15% or more. And 25% had underperformed by at least 5% for more than 3 years. And yet when you looked at the total over 10 years, those are the funds that outperformed. Those were the funds that actually had superior performance. There have been a number of studies that have looked at mutual fund managers and how they manage. And they found that a lot of mutual fund managers are actually closet index managers, because it goes back to some of the stuff that I talked about earlier in the program. 19% of managers lose their job within the first year and another 19% within the second year. How do you assure you're going to keep your job? You keep your job because you perform pretty close to the benchmark. And how do you get close to the benchmark? You build the fund so it looks like the benchmark. And so you end up not taking logical, positive things, but you end up trying to look like your benchmark. You put a lot of stocks into the mutual fund, and you take very little chance. The funds that outperform have some characteristics. They tend to be more concentrated. They tend to be really a stock pick of the manager. They tend not to be reflective of the benchmark, but they tend to be driven by a manager who makes a decision. When I'm looking at stocks, I look at 30 or 40 stocks a month, and I drill down on about 8 or 9. I really drill into 1 or 2, and I only make a couple trades a year. And in my portfolios, we have only 10 to 12 stocks in the average client's portfolio. It's a very concentrated portfolio. It goes back to what Mark Twain said. Mark Twain said, put all your eggs in one basket and then watch the basket. That's a philosophy that has worked for me, and it works for a number of other people. It's a conviction of the manager that this is an investment that's worth making. But a lot of managers of mutual funds will focus on trying to keep the fees very low so they can say we have really low fees, but they tend to be closet indexers. That's one of the issues. That's part of the Baltimore stockbroker issues. Something you never see, they never talk about. They don't stand up in front of a crowd and say, I really try to keep my fund just like the index. No, they try to say, this is our investment philosophy and this is what we do and this is how we go about it. The reality is it's a spin. Just like the Baltimore stockbroker said, I was right 10 times in a row. It's a spin. And yet you don't see it. You didn't see it when you were receiving those emails from the Baltimore stockbroker. You don't see it because they're not going to get up and be honest about it. Anyway, that folds that up. I want to introduce my speaker, or my guest today. He has a very interesting story to tell. Jim Tracy of Legacy Communications. Welcome to the program, Jim.
Thank you, Mike. I appreciate being here, and I'm not from Baltimore.
That's good. And you're not a stockbroker.
And I'm not a stockbroker.
So, Jim, you're with Legacy Communications.
Legacy Telecommunications.
Telecommunications.
Yeah.
Let's start with your background.
Okay, I'm a product of the Midwest. I wasn't a farm kid, but I was on the edge of town, and my dad made us work on farms, and went to Minnesota and found a great gal from Duluth, and went to college because her dad made me, and got a job in Minneapolis, and then got another job in Denver, and in the early 90s we moved out to Seattle to work out here, and in 2000 launched Legacy Telecommunications with my oldest son and some other family members, and built cell towers and communication towers, really, and communications infrastructure now, and now we have 5 divisions.
So now these are the towers that we see scattered around and that we communicate with, right?
Correct. That's correct. And those infrastructure are now no longer limited towers. Here in downtown Seattle, there's a lot of rooftops with communications infrastructures on them, and so we work on all of those.
So let's start and back up a little bit. You hear people talk about we're right now at 4G networks, but we started at 1G, 2G, 3G. Tell us about that.
Well, if you make an analogy, 1G is kind of like a gravel road, and that gravel road allows, pretty slow travel in both directions, and that would be equivalent to 1G. 2G then is a
Then 1G was what we were using when we were using dial-up.
Back in the day when dial-up was, we've gone through the 2G and the 3G, which would be kind of a highway, and a 4G, which is a 4-lane freeway, and now we're headed for 5G in 2018.
So when we talk about that, and you talk about the highway, we're talking about the transmission of data, right?
Correct. Radio frequency signals through the air, carrying data, whether it be in the form of electrical pulses or light in the form of fiber or radio waves in wireless.
So we're coming up to a commercial break. So I want people to stay with us. We've got a lot to talk about. There are so many things going on in the telecommunications and where we're headed. You want to hear the rest of this story. So stay with me. If you miss any of this program, you can find it on our website. There'll be a podcast. We do iTunes as well. No, we don't do iTunes. I just got the word I guess we don't do iTunes. Anyway, you can find it on our website. You can find the podcast. Don't go away. We're coming right back after this commercial break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Jim Tracy of Legacy Telecommunications. We started talking about the 4G, 5G communications and understanding what that really is. So let's go back to that and talk about what it is. You gave the analogy of highways and roads. But what really is it?
Well, when we talk about a G, the G is the generation. So first generation, second generation, all the way through now. Coming up in 2018, of course, is the rollout of 5G, or the fifth generation of wireless. LTE, a lot of people have heard that phrase before. That's an acronym for long-term evolution. This is the natural process of getting data from one place to another place faster and more efficiently, so that the data speeds increase and we aren't stuck in that dial-up era anymore.
So if what I hear you saying, back a few years ago, Apple came out with the iPhone. And not only did they come out with the phone, but they came out with a lot of applications. And that consumed a lot of data that was traveling. And so I assume what you're saying is that had we not increased from the old communications network, it would have crashed. Everything would have crashed. It couldn't have handled the data that was being transmitted.
It actually did crash. As a matter of fact, if it weren't for the tower industry, especially the tower infrastructure industry, Steve Jobs might have been a footnote in history, but we made it so that his phone worked well. And not just the iPhone and the iPad, but all the Android devices and all the devices that are now part of the wireless ecosystem. And this ubiquitous network that we're requiring is a function of the habit of the user. And so what we're doing is tracking the users and making sure that we deliver what they expect.
So if I make an analogy, I have a car. I get in, I drive the car. I never think about the powertrain. I never think about how all it functions. And what, people see the Apple phone or the Android, but it's the matter of what the infrastructure is behind it.
Right.
That it wasn't just the phone, it's the infrastructure which enabled all of that to happen.
Correct. And part of what I do with the National Association of Tower Erectors is that we focus on the safety of the individuals that actually provide that signal for you. And they climb up a tower and you don't see that. You don't realize that there's a whole skill set there. These guys used to climb up a piece of steel and hang something, and now they're climbing up there with all kinds of spectrum analyzers and pieces of equipment that we really don't. We can't keep up with the acronyms quick enough in our industry.
So as we talk about cell towers, we talk about a lot of the phones, but we have a lot of things coming down the road, like self-driving cars and whatever. Isn't that going to have an impact on cell towers?
It's going to fundamentally transform not only our industry, but the way that America actually communicates. If you look at the connected cars out there, and look at how many cars are on the road, and as the next generation of cars come up, they're going to rely on this infrastructure in order to give the owner information about where they are, where they're going. When's the last time you walked in a convenience store and saw the map rack? right there. There's a whole skill set and there's a whole flavor of America that's gone because we used to pull over and tell our wife we actually didn't need a map, and now we don't.
You know, I happen to have a Tesla, and the map is on the dashboard. You just plug in a number, and it shows you where you're going.
Yeah.
And in some ways, it's sad because it used to be when I drove somewhere, I would remember the route. I only had to drive it once. Now, if I don't have GPS, the second or third or fourth time I drive somewhere, I get lost.
So here again is an example where wireless, especially the computing ability and the speed and knowing where you're at, has really fundamentally changed the behavior of a consumer.
And it's more and more data that needs to be transmitted.
And that data has to be transmitted bidirectionally. So it's going not only into your Tesla, but out. And as that happens, we need to increase the throughput, both upload and download speed. So that's why we need these larger, more efficient networks.
And so if you have a tower and you're transmitting things through the air, then how do you improve the speed of data transmission?
Well, you can't really improve the speed of data transmission through the air without more efficient radios. And so one of the things that has happened in our industry is the radios have moved from the ground to up high in the tower. And so now we have more spectrum capacity. We got the radios closer. We've taken fiber all the way up to the tower into the radios. So that data transmission not only is faster, but it's on a bigger highway. So we used to have one antenna that would take 6 calls. Now we got one antenna that'll take 100 calls.
Incredible. So what about, the data transmission if I make a call or if I want to transmit data from Seattle to New York City? How does that whole process work?
You're gonna actually leave your handset and you're gonna go to a tower, and that tower is gonna take the signal and convert it from a radio frequency into a light image, and then that light image is going to be transferred back to a central office, and it's going to go through fiber or in some cases microwave dishes all the way across the Rockies, across the Great Plains, over the Great Lakes, through the Appalachians, and you're going to say hello New York City, and they're going to recognize your voice after it's been converted back from light. Let's say it goes to somebody's home, back from light to copper to a sound wave. So
does it go, when you say it goes over the Appalachians and so on, does it go from cell tower to cell tower then?
No, it goes over the plain old Ma Bell system that's been there for a long time, that has been upgraded to change from copper to fiber.
Okay.
Generally speaking.
But they had to upgrade the fiber system to it.
Yes. Yeah. And not only that, if you think about it, we don't pay long distance phone bills anymore because, well, everybody's got a free phone. And somebody paid for that, and fortunately, we've got a network that will support it.
Yeah. And as we go from 4G to 5G, give us an example of what that really means.
In practical terms, if you took a mobile device like an iPad and you downloaded a full-length motion picture at 4G conventional speeds, you're going to, I think, if I remember right, it's like 17 minutes or something, 13 minutes maybe, to download a full-length motion picture, audio and video. At 5G, it's prognosticated that that's going to happen in 17 seconds or 13 seconds instead of minutes.
And what that means is people can move a lot more data. Companies will find more and more data to move, and it becomes more dependent. If you think today, if we were to say, let's go back to dial-up networks, it'd be a disaster.
A lot of people ask me, haven't you guys built enough towers yet? And functionally, the answer is there's a lot of towers up there, but we haven't even come close yet because the macro networks, as far as that goes, still need to reach large areas over, especially rural populations, where we need to add a lot of user and a lot of data so that the rural populations have the same benefits as the urban ones. But in urban areas like where we are now, we need those microcells to actually make sure that somebody is getting signal because there's a lot more density here.
And with more cell towers, especially in in dense areas, will we reach the point where we don't have calls that are dropped?
That's a great question. I think that there are so many opportunities for improvement in our networks, and a lot of that is going to be hardened as we come up, and we're going to start building shortly the nation's first public safety network. Well, we're developing like definitions right now for what a hardened network is. So I think you're going to find that today's digital signal is a great deal more dependable than it was, say, 5 years, especially more than 10 years ago. And it's only getting better. The story just keeps getting better.
So you mentioned the first net. Talk about that a minute.
The FCC auctioned off what they would call spectrum or radio wave property, and they said, we're going to take this money and we're going to invest it in a public safety network where it's interoperable. And so the police and the firemen and the medics, paramedics, and EMS can all speak one to another on a network where they're using the same frequency. And that was a $7 billion investment of not tax dollars but auction dollars that was awarded to AT&T, and construction should start sometime next year on this network. 15 states have already opted in to say, hey, we want to be part of this public safety network, and it's on the same frequency as the folks up in Canada. So it'll be seamless transition communication for our public safety. And these folks are taking care of the United States in terms of all of our emergency responses. So in the event, heaven forbid, of another 9/11, these guys can talk to one another rather than being kicked off a network.
Awesome. You're doing great work. It's a great story. It gives insight into what's going on. It's not just the phone, it's all the infrastructure that's behind it. Fascinating. Thank you, Jim.
All right. Thank you, Mike. Appreciate your time today.
And I don't know if anyone would have a reason to contact you, but if they did, how would they do that?
If you go on our website, it's legacytowers.com.
Great. Thanks for being here. We're coming up to a new segment, and I want to talk. It's always good to talk and review history, because if you don't know the history, you're bound to repeat it. So don't go away. I want to talk about the panic of 2008, 2009. Be right back after the commercial break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So welcome back. And you know that if you've been listening to this program very long, you know that I believe that history doesn't repeat, but it rhymes. And if you're not aware of history, you're going to repeat it time and again. So it makes sense to go back and think about great bear markets, great bull markets, secular bull markets, and it also makes sense to talk about what happened in 2008, 2009. And the basis of a lot of what I have to say is based on a book called Slapped by the Invisible Hand, The Panic of 2007 by Gary Gorton. He was with the Federal Reserve, he was Wharton, Yale. And when he says the invisible hand, That's economist jargon, I guess, is the best way to say it. Jargon meaning the economy. And we heard again and again during that time a systemic problem. Systemic. Systemic was a nice way not to say panic. But in reality, in the old days, they used to say that was a panic. And there was one difference between what we went through in 2007, 8, and 9 and what we used to go through in bank panics, and that's that in previous panics, they were visible to everyone. But in 2007, they were only really visible to insiders. Most people had never heard of the markets that were involved. They didn't know how they worked. They didn't know what purpose they served. For most people, credit default swaps was something they'd never heard about, never understood, and maybe today don't understand what they are. Repos, collateralized debt obligations, collateralized mortgage obligations. In previous times, people feared for their savings. When you had a run on banks, which was a panic, when you had a run on banks, it was primarily individuals. You would go through a recession or a depression type time, and people would run to the bank to take their money out before the bank failed. And if you just had one bank that was in trouble, the other banks would pool their monies and put it into that one bank, and people would take their money out. They'd feel comfortable after a day or two and put the money back into the bank, and everything would go along. But if you had several banks, a number of those banks would fail, because as money's deposited into the banks, if somebody puts $1,000 into the bank doesn't just stick it $1,000 into the vault and hold it. They have to make money. So what they do is they loan out $950 of the $1,000 to homeowners or to businesses or to developers or to companies. That $950 is illiquid. So when you get worried, when a bunch of people get worried the bank's going to go under, you rush into the bank. They don't have your $1,000. They have only $50 of it. And so the first people that get their money out take all the cash out. And if you're the 10th or 15th or 20th person in line when you go into the bank, you can't get your money. Or that was the way it was until the 1930s. It's not been since the 1930s that we've had a panic like 2007, 8, and 9. Prior to the 1930s, we had a number of panics. We had the first Great Recession of 1838. We had a depression in 1848. Going back to 1796, we had a Great Recession. Going back to 1874, there was a lot going on at that time. And instead of a Federal Reserve or a bank bailing us out, the government and the arguments were the same: let the survival of the fittest survive and let the others die. And we went for 30 years, every other year being recessionary year, and we ended with 6 panics. But in 1930s, in the Great Depression, they came up with an idea of insuring individual deposits up to $100,000. And that became assurance, so people didn't run into the bank. They were assured that they were going to get their money out because it was backed by a moral obligation of the U.S. government that they were going to get their up to $100,000 out. And so we didn't see anything. Economists called that the golden period. You had economists that predicted we'd never see a panic again. Any number of economists predicted that. But what they didn't understand is that in the 1970s, you began to have a shadow banking system. You began to have General Motors and Ford doing their own financing. You had General Electric doing their own financing. You had the growth of endowment funds at colleges and foundations. You had the growth of the hedge funds, all creating large amounts of cash. And when they put that cash in the bank, they were depositing not $100,000, they were depositing $100 million. And they wanted some assurance that they would have some protection and they would be able to get their money out. And so the banks which originally began to generate the collateralized mortgage obligations, collateralized debt obligations, began to put together these mortgages into packages and use those mortgage packages to guarantee the money for big chunks of money coming in through the shadow banking system. And those became the repos, because the repos traded daily, traded oftentimes, several times during the day. The repos were essentially collateralized debt obligations, which consisted of a lot of mortgages or credit card debt or student debt or other debts that had all been packaged together. And people figured, because you're putting together a large package and instead of 100%, you're allowing 5% or 7% or 8% to default, you're never going to have a problem with that. Never going to have a problem. It's just guaranteed, right? Until subprime mortgage came along and some of those began to fail. And then it was not just subprime, it became prime mortgages. And then it became car loans, and then it became student loans, and then it was a domino effect. But in addition to that, the banks and the people who were depositing money in the banks, they wanted to have some assurance that they were going to be able to count on those collateralized debt obligations. So they began to do credit default swaps. And so when you had Lehman Brothers go down, you had a panic set in. All of that to say, there was a huge amount of debt and credit that was outstanding. And that was the precursor to the Great Recession. Not just in 2007, 2008, that was a precursor to 1932, that was a precursor to 1874, it was a precursor to 1838, 1848, to 1796. You had to build up a huge amount of debt. Very, very high levels of debt. Today we don't have that. But it's good to remember that. And it's also good to evaluate when people are talking about the great crash of 2017 or 2018, to know we're not in that credit position where we're going to see that. I've talked about the super cycle. Today in the Wall Street Journal, it came out and said that all the world is growing again. We're in a secular bull market. We're not in a panic situation. Doesn't mean we won't be in one in 5 or 10 or 20 or 30 years from now. But for now, we're in a secular bull market, and there's a reason to be invested. That wraps up today. Have a very great weekend. Have a very great week. And I will be back next week to talk more about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on Adams Financial.